Good afternoon to all participants. This is Krishan Arora, partner and leader in the Tax and India Investment Advisory. Welcome you all on behalf of Thornton Bharat and my esteemed co-speakers. We are delighted to host another session on decoding the impact of 56th GST Council meeting recommendations, and this time focusing on what industry sees and needs to know beyond the fine print. It is interesting to note how these reforms have been positioned at the highest level. PM Modi, in fact, called this a GST saving festival. He welcomed the new generation of GST reforms that took effect from September 22nd, underscoring that these GST changes, along with the income tax reforms which were announced earlier this year, will translate into savings of nearly INR 2.5 lakh crores for Indians. He aptly termed this collective reform package as Bachat Utsav, a celebration of savings that reaches every household and business. In our previous webinar, we unpacked the Council's announcements and explored their implications from a broader GST landscape. We also examined the headline reforms from the shift to a two-rate structure, long-awaited operationalization of GST tribunal, to the removal of intermediary place of supply provisions and amendments related to post-sale discounts, which were very important. We also highlighted trade facilitation measures such as automated provisional refunds, simplified GST registration and relief, aimed both at households and businesses, making a clear move to GST 2.0. Now, building on these policy announcements, the government had already swiftly moved to operationalize these changes through a series of notifications supported by FAQs and timely circulars addressing pricing aspects. Most significantly, the circular on post-sale discount has brought long-awaited certainty on their tax treatment, finally putting to rest many interpretation issues. Together, these measures underline that beyond rate rationalization, procedural reforms and transparency are being advanced with a clear focus on ease of doing business. Today, we take this conversation a step further, shifting our focus from policy to practice. We will delve into how these changes are being experienced at a sector level, the growth opportunities they present, and the challenges and unresolved issues that remain. This is just not about rates on paper, it is about how industries, their supply chains, their processes are responding in real time. Are these reforms being seen as a positive catalyst for demand? Are they broadly neutral, requiring careful recalibration? Or are some sectors feeling added pressure from the transitional complexities? We will also touch upon the growth imperatives that GST 2.0 sets in motion, from the potential demand surge in automobiles and consumer durables to affordability gains in FMCG and healthcare sector. Equally, we will examine where the gaps remain, like the issue of standard compensation sales balance, lack of clarity on ITC refunds, and impact on incentive-linked reimbursements at the state level. Above all, I think this session is about practical insights. Our aim is to bring together perspectives from across industries to understand how organizations can leverage this transition, not just as a compliance requirement, but as a platform for growth. With that, let me welcome my colleagues and panel of experts who will share their views through this discussion along with me as to how these reforms are really playing out across sectors. I'm joined by my colleagues Bhanu Prakash, partner and healthcare sector leader, Naveen Malpani, partner and consumer industry leader, Saket Mehra, partner and auto and EV industry leader, Neeraj Sharma, a seasoned chartered accountant who's also an experienced expert in real estate and infra sector, Raja Lahiri, partner and tech industry leader. And to make this discussion more effective, I'm also joined by my tax domain colleagues, Karan Kakkar, partner tax planning and optimization, and Saurabh Bararia, partner tax planning and optimization. Together, we'll attempt to bring practical insights and nuances across key industries and policy discussions. And before I hand it over to my colleagues Karan and Saurabh, I would encourage all participants to actively engage by submitting your questions in the Q&A box, which is there on your screens. Our teams will try to address this in real time during the course of or towards the end of the session, making this session more insightful. I've already received questions and queries from certain people in the audiences, which I'll pick up as part of the panel discussions towards the later part of the presentation. So once again, ladies and gentlemen, thank you for being here. The conversation ahead is designed to move beyond notifications and circulars into the real-world impact these changes are likely to have on industries and their supply chains. We hope to make this session not only insightful, but more practical and forward-looking for your business considerations. With that, let me invite my tax colleagues, Karan and Saurabh, to walk us through some of the key sectoral impact of these reforms, highlighting the opportunities they create, the challenges that remain, and the open issues we must keep in mind before we move into a deeper panel discussions. Over to you, Karan and Saurabh.
Sure. Thank you, Krishan, for setting it up, and really privileged to be speaking before the audiences and all of you. So I'll quickly take it from where you left, Krishan. So it has been massive reform. After 8 years of implementation of GST. So you know I could only categorize or bucket these reform into three categories. One is, of course, a rate rationalization, which has brought down a 5-tier rate system to a 2-tier rate system effectively. So which means only 5% and 18% remains. And for very few goods, it is 28%, which will remain, and 40% is for the sin goods and the premium goods, so to say. So very welcome kind of rationalization which was required in the GST regime. All these rate changes have taken place from effective from 22nd of September, which is yesterday. They all are effective. The rates have been announced. The products and the services both have been announced and notified both. So this has already seen light of the day yesterday. And to be as practical as yesterday, I was looking at the invoice. The retailers level have started passing on the benefits in the name of GST rate reductions. So that is a welcome move, and boost what the Prime Minister of India wanted to really have, that it really percolates down to the end consumer. There has also been structural reforms. GSTAT, which is a GST tribunal, it was far pending. The operational date has been announced as 30th of September. All the backlogs and the hearings are to be concluded or to be submitted by 30th of June 26. That has been the date, which is again much awaited the reform which was needed and need of the hour, because lot many litigations are pending. Intermediary, this is has been a bone of contention and a cost for the industry, specifically IT, ITS, GCCs, or marketing companies who are kind of providing these services and exporting out of India. So they have announced in the GST reforms in the press release that intermediary will be at par with other services and be treated to be zero rated. However, the notification has not been announced, because this requires a legislative change, which will only happen once the law and the legislation changes through the parliament session. Would be so we see this as very important, massive change which is going to happen in coming future. Another ease of business, like Krishan you mentioned, was on the another aspect what they've bought is post-sale discounts. A lot of dispute and litigation was around this point for across industries. There have been circulars around the treatment of how to deal with the post-sale discounts. The linking of the agreement of the post-sale discounts have been done away with, which is a welcome move. And this will definitely ease out the pressure of giving any impromptu discounts or festive discounts or any other discounts, or any innovative discounts what the companies bring in to churn the goods. So this has been a very important move. The another facilitation measure is 90% of provisional refund has been announced, which was already there in the law, but they have re-emphasized that it will be given to the less risky exporters. The risk of the exporters are going to be monitored by themselves. So there are going to be various parameters which are, of course, not known to the industry. So one of the parameters, or couple of parameters, what we think is the returns are filed on time. There has not been any delays. The registrations are updated. The export transactions and the conditions of export are met all the time. So those kind of exporters are really going to face very good times ahead. Moment this 90% provisional refunds are granted, because this will immediately improve the working capital. And of course, on the registration side also, they have simplified the reforms, and the registration today, it used to take, 30 days. They have simplified it to 3 working days. And of course, these are again linked to the risk profile of the, registration registrants who are applying for the registrations. Mostly, all the companies, MNCs setting up GCCs or ITS back offices, or small players who are supplying through electronic commerce operators, all those suppliers are going to benefit out of the simplified registration regime and going to obtain registration within 3 days. So having said the context of the announcement of the overview, we jump on to the sectoral impact. So to start with, the automobile sector. So this sector has seen a very, very important reform, and which was much awaited. The affordability of the small cars, which are petrol or diesel, which are below 1200 cc and below 4 meters length, have gone down. So which means a a boost to the mass consumption. The masses can go after and buy these cars at a cheaper rate than before. The earlier rate were anywhere between 29 to 31%, because it also had the component of compensation cess that has been again done away with this industry. And likewise, any motorcycles below 350 cc have gone down to 18%, and any other cars which are beyond the specifications of 1200 cc and above 4 meters of length are going to enjoy the rate of 40%, which was as against 48 to 50%. And also there is an important boost to the commercial vehicles. They have been reduced from 28% to 18%, which is definitely going to improve the logistical SMEs and rural healthcare providers in this space. And even for the agriculture sector, indirectly, there have been a very important change from 18% to 5% on the tractors have gone down. For the EV sector, EV cars, the GST rate remains at 5%. So this is again to promote the sustainable mobility and encouraging the transition from the cleaner future. So that is the massive, massive reform what we have seen. And the major point of litigation under this sector was on the automobile parts. So they have brought most of the parts, or I would say all of the parts, under one rate, which is 18%, irrespective of the HSN classification. So earlier there used to be disputes of 28% versus 18%, depending on the classification. Now, irrespective, if any parts are used for automobile sector, they are under 18%, which again is a very, very important move for the sector. So what happens to the compensation cess is, yes, which has already got accumulated. There has not been any announcements or any clarity. Rather, the CBIC chairman, the other day announced that they have not thought about anything, for compensation cess, and not they are thinking on the refund lines. So, which is giving an indication with what happened during the service tax regime for the education cess and the secondary education cess, that it got lapsed. So unless and until there is going to be any clarity or for clawing back of the accumulated compensation cess, it seems to be asset lying in the books of accounts, but may not be able to utilize, because compensation cess currently can only be utilized against the output liability of compensation cess. It cannot be set off against any other GST liability. So yes, all in all, this is the impact on the automobile sector, making it more affordable for the masses. And now we move on to the another essential sector, which is healthcare and pharmaceuticals. This again has seen a massive, massive rate rationalization. So the rates, have effectively gone down for various products and drugs from 18% to 5% to 12 to 5, or even exempt for life-saving drugs. So this is a very, very important move. This covers, broad healthcare affordability for the patients and even in the pharmaceutical space. The affordability of normal medicine and drugs is going to be far more better than what it was earlier, because of the rates going down. And even the job work, because the model for the pharma companies we have seen in our experience is that a lot of drugs are manufactured or given as on a job work basis. So the job work rate of GST also has gone down to 5% from 18%. So this also has kind of uh, eased out, or this might reduce the cost of the pharma products which are getting manufactured in India. However, to large extent, I would say the inverted duty structure had been addressed in most of the cases. But the major component, what goes into the manufacturing of pharma products is APIs, that still remains at 18%. However, most of the products are either at 5% or exempted. So that again will lead to additional burden of inverted duty structure, and the refunds need to be claimed by these companies or this industry. The another important move is on the healthcare insurance. If we talk about healthcare affordability, it has gone down for individual life insurance and healthcare insurance to from 18% to exempt. So which means the purchasing power or the amount what is going to get saved in the hands of the end customer, like you and me, is going to be far more, for which we can have a better coverage, better affordability. We can add on the riders on our insurance policies, which are existing policies, which is going to happen. So this brings a very, very important change for the in the healthcare industry as well on this insurance side. What happens on the inventory which is lying? There have been circulars which have been introduced. The expectation was that the benefit of these rate changes should reach the end consumer, which I mentioned that it has started happening. We have seen that happening in the bills. So there have been there have been circulars which said that stickering of MRP or relabeling of MRP is voluntary. If somebody wants to do it, they can do it. If not, then they will need to ensure that the benefit really percolates down to the end consumer eventually, and not only at the distributor or a stockist or a retailer level. It should go down to the end final consumer. So that is the trust based ask what the government has kept before the industry. And I'm very glad to see that in at least a couple of examples that industry is really living to that expectation of the Prime Minister and the Finance Minister, and they are doing it voluntarily and passing on these benefits. So now moving on to the next sector, which is a technology sector, primarily services sector. I would say the massive change which has happened and which was need of the hour had been I would say, thorn in the skin during the service tax, since the service tax regime was on the classification of intermediary. So what is intermediary? Intermediary is nothing but a person or a broker or an agent who is connecting a supplier of main service with the end consumer. So this is a layman understanding of what intermediary means. He's connecting two people for either goods or services, and those, so for that effort he's charging to the main supplier or supplier of goods or services, whosoever he has the contract with. So in this case, what used to happen, or what is currently the regime, what it says, that any export for such services of intermediary will not qualify for zero rating. So what did that mean? It meant that on every invoice of such export by the Indian company to the foreign company, whether it is parent company or a subsidiary or unrelated parties also, 18% GST used to be loaded to the on those services, making the services export from India expensive. So now what they have proposed, which I said, which will be only active after the legislative change happens in the budget session or the vintage session. In that case, only these services will qualify for export as per the recommendation or the reform which has happened, at par with any other services, making the services export from India more affordable. So who are going to be the real beneficiaries of this intermediary currently? are, GCCs, MNC subsidiaries who are exporting to their parent companies, ITS companies, marketing support companies, all these companies, or any manufacturing company also who are into, providing these marketing support or intermediary services are going to get benefited immediately, and 18%, which used to be a cost on the transaction, will be absolutely zero, which also means the ITC, which was getting accumulated, will be eligible for refund and for these companies, and which will improve the competitiveness of these setting up of these kind of structures and the transactions from India and exporting them outside India. So yes, more or less, I would sum it up for this sector that this is a very, very important and a welcome change which will happen, what we'll see. I also believe it is going to be prospective, not retrospective. And for retrospective, current law would apply, and any litigation which are going on have to be seen as per the current provisions. This is what the intent is also going to be looking like. And from here, I pass it on to my colleague Saurabh to take it on for the other sectors. Thanks.
Thanks, Karan. I think that was really helpful, and I'll move on to one of the most important sectors which is impacting today every consumer. I think I would want to start off by saying that in the speech which our Honorable Prime Minister had given for before the start of Navratra, he's clearly mentioned that every consumer will see a lot of boost in terms of their overall expenses going down, and that is something which was really important. I think he highlighted the fact that around 99% of the products have been moved to a lower rate to help consumers buy more, to boost the overall sale of essential items, and of course the penetration into tier 2 and tier 3 cities. I think that was a clear vision, and what a way to start with Navratra. I think that's a clear message which the government wanted to pass on. But having said that, we are aware that a lot of these essential commodities, as you can see on the screen, right from biscuits, cake, bakeries, they've moved to 5. So is the case for other namkeens, etc. We've also seen that a lot of white goods which we buy, such as TVs, ACs, dishwashers, they've also moved into the lower bracket. But what needs to be seen here, and most importantly, is how you manage the transition from a GST standpoint, because a lot of these sectors are driven through the distributor and dealer channels. So it's very, very important that, what is the position being taken for inventory. For example, practically some e-commerce players are actually wanting, their manufacturers to take back the stock and reissue at lower rates. So that is a practical challenge which we are seeing. We are also seeing challenges in the form of post-sale discount clarifications, which has come. While the clarification is a boost to the industry from an overall tagging perspective or part of the contract perspective for primary and secondary sales, but government has clearly, left certain areas untouched. So that is something which is important for this sector. But yes, the positive is that it's going to enhance affordability and drive consumption-led growth. I think that is what India is wanting to do: make in India, consume in India, and the best things needs to be available for our people. Inventory, of course, we highlighted that there is a need for repricing or discounting, and what is important is the margins, because margins need to be kept intact by players across levels. So that's where the entire profiteering element pass on will also come into play. While there is a suitable clarification around that this needs to be not seen from an anti-profiteering provision perspective, but more from a consumer court perspective. But it's very important that the benefit be passed on to the end consumer. And like my colleague Karan highlighted, for pharma, same is the case for consumer. I think one of the other important aspects is the fact on granting permission to revise MRP of unsold stock, the clarification. And this is for pre-packaged commodities. So while MRP revision is required in cases where there's a significant reduction, keeping your margins, of course, intact. But what is important is government has said for stock and inventory, which is in hand, that need not be at this point be relabeled. And instead, a communication can be given to the dealers. And practically, we've seen today, as things have gone live since yesterday, we've seen in stores, etc., that, people are passing these by way of discounts. So that is something which the industry is saying. Then, of course, the reduction in the rates of, consumer electronics, white goods, etc., will push a lot of people to buy towards them. I think one important last point which I want to highlight on this sector is that while the government has wanted to increase the affordability and let people to, buy more and increase the overall consumption, I think there are some areas where, it's important to analyze that, the rates have also gone up. So for instance, textile sector. So while the boost is there on FMCG, the textile sector or the retail sector has seen, that for products above 2,500, the rate has gone up from 12 to 18%. I think that's an area which, probably the sector is looking at a little differently. They feel that, it's a little troublesome because it's a 6% increase in the effective rate, which of course, from an overall margin standpoint, will also impact. Having said that, overall, the sector has seen a lot of boost, and we've seen prices and discounts being offered by players at the retail and at the distributor level. Next slide, please. I think the other one is real estate. I think this is another very, very important sector, on what the economy is based. I think there was a lot of issues and challenges on the buyer sentiment. We've seen COVID and post-COVID where, prices fluctuated a lot in terms of the overall rates. So to improve this sentiment, government did go in for a lot of composition schemes. So today, residential projects, etc., are under composition scheme of 5 and 1, and commercial projects are at a higher rate of 18, which is effectively 12%, because the value of land needs to be included in that 1/3 calculation. So I think the largest boost to this sector is the fact that the rate of cement has gone down from 28 to 18%. I think that is something which this sector is actually given a thumbs up to, because yes, cement constituted a very large portion of their input costs. It is expected that the construction inputs, such as cement, natural stone, etc., will help reduce the overall cost of construction, and the compensation cess, etc., which is there owing to coal. That is something which also the government will be taking care of by way of, although coal's rate has gone up from 5 to 18, but overall it's a boost for coal buyers, considering the fact that the compensation cess impact was huge for them. There is a lot of rationalization which is required on the input side, and that is something which people need to take care of. Even for government contracts, as you can see on the screen, for offshore contracts, while the rate has gone up, it is somewhere aligning with what the input costs were, and therefore the impact will not be as large as it was thought to be. The important aspect for developers and for construction players is they need to actually revisit their contracts. And I was having a discussion with someone today morning who told me that these builders, will they actually pass on the benefits of the rate reduction of inputs to the actual consumer? That is a wait and watch game which we have to see, because that is something which ultimately, at the time anti-profiteering also came into play. These builders were massively impacted and they had to show it. We'll have to see how they actually pass on these benefits in the form of discounts or lower EMIs, or they see that the overall cost of the project, was it a loss, and this GST is becoming a boon for them. So that is a wait and watch thing. But yes, declaration of revised MRP for cement and revised pricing for these construction contracts is something which needs to be seen. I think that this also calls for a recalibration of the entire ITC planning. And lastly, I think this sector has got a lot of incentives also. So if you look at cement players and other players, I think there it's a direct impact, because these incentives are rolled out by the government to these large manufacturers for actually Make in India and for increasing their production. Owing to the rate cuts, the SGST element of these incentives would actually come down. So it is a wait and watch in this sector that how actually they will, support in passing on this. With that, I would like to hand it over to you, Krishan, from an overall perspective.
Thank you. Thank you, Karan. Thank you, Saurabh. Both of you, I think, sharing some key insights which are more practical and sectoral impact. And I think we touched upon very important issues from post GST 2.0 reform activation, and especially with the issues which continue to remain in terms of any duty inversions, fast tracking of refunds. I think having to kind of talk about the impact of compensation cess, which is lying, unutilized, what will happen to those. Some of these open points will definitely be something which industry is really looking out to, and that brings me to kind of some mood questions which I would want to put up to my colleagues who are the sector experts here and the leaders here, and we'll open the panel discussion here. I've already gathered questions which have been put up before ahead of time when we requested audiences to reach out to us and ask those questions. I've compiled some of those, and I'll pick up some more if they come up during the course of the session. But I'll go back to my first question will be on the pharma sector and healthcare sector to Bhanu. Bhanu, you are an expert on the sector. You're working very closely with clients, and we've seen most of the items on either being exempted or moving to the 5% bracket. And also from the individual health and insurance standpoint, Karan talked about it, that it's an exempted activity now, and there will be a play of without a GST, premiums to be charged to customers, which is the boom. From your perspective, how do you see this impact with will change in influencing the affordability, the global competitiveness, and India's position as the pharmacy of the world?
Hey, thanks, Krishan. Good afternoon, everybody. I think the reduction in GST will definitely improve affordability and accessibility of healthcare for common man. I mean, Karan has already covered on the various tax slabs, so I will not get into that. But if you really look at today, like the nil date on 36 life-saving drugs is definitely going to ease the burden of cost of healthcare for many. It's important to note that many of these are life centers, including cancer care. So India has one of the highest incidence of cancer care. So that's one. I mean, and government has continued to focus on the preventive care. So if you look at the duty reduction on some of the tests like glucometer and others, is also bringing more affordability for the preventive care. Again, point to note is that 10% of India population has diabetes. So it is addressing a population, and in general, India is moving from a communicable disease to non-communicable disease. So many of these tests will sort of make that more affordable. I think the cost of insurance, 18% to nil, that's a great move because today, 40% of the India population, what we call as missing middle, is not covered under any insurance. And hopefully the cost of insurance coming down, some of them will probably go for insurance, which will eventually bring down the cost of out-of-pocket expenditure for India as a whole and for the individuals. Many of these changes will warrant the change in the price masters, inventory management, supply chain logistics, affecting the revised price on the drugs. We have already seen that, which is happening in the market now. Today, if you go and see some places, you will definitely be able to see the price reductions already. I mean, if you see today Big Billion Sale, you will see the changes also from the e-com. I'm sure Naveen will cover more that in detail. But there is an important that all the stakeholders in this network, and whether it's pharmacy, pharma companies, distributors, or the pharmacy outlets, hospitals, will have to leverage technology to make these changes, effectively showcase the changes and help the common man. I think while the end dosage prices have changed, I mean for the final medical products have been changed. Karan did touch about the inverted duty structure because some of the APIs are still at a higher rate. One of the big expectation was healthcare, which is currently under exempt. If it had come under zero duty, probably it would have further brought in a better benefit. Also, I think some of these probably Karan will touch more on detail in terms of the nuances on the inverted duty structure. So in summary, on an overall basis, this is definitely bringing the cost of healthcare out of expenditure. and in the hands of it is to build a healthy India, a healthy workforce who can shape a vibrant Bharat. I think even from a medical tourism perspective, this will, also make India more attractive because the cost of healthcare will come down. And I'm sure Raja will touch on the benefit of to GCCs in the because of the some of the duty benefits which Karan talked about. Overall, I think great initiative, all in the right direction to improve the affordability and accessibility for the common man. Thank you.
Thanks, Bhanu. And
Karan, I think you may want to cover the inverted duty structure.
No, absolutely, absolutely. And I think thank you. Very important point there was about affordability and giving that benefit back to the consumers. And I'll just share a quick example because I was waiting a life insurance long-term policy which was continuing, and I got a premium notice right before right before the GST changes were announced, and I was obviously there. It had an 18% GST on it. And I stopped myself from paying it, thinking and hoping that this 22nd September date comes. And by chance, my due date was 22nd September. Yesterday, I got a fresh premium notice without the GST. So actually, that benefit was passed on the last day. Was me, luckily, was on 22nd September. But I think the intent was clearly visible of the insurance companies. Even if there is a blockage of ITC, which would have happened because GST will not be charged, they have the intention has been that the consumer should get benefited, and right from the day one it happened. So I think that's the way actually the industry is actually responding back while there are challenges which you talked about. And I'll put Karan, this question to you. I think we all are aware of the challenges from the inverted duty structure standpoint, transition stock planning. I think it's a huge exercise for pharma companies. I think price impact on incentives which are continuing because there is a state GST component which is always been a part of incentive packages which are granted by states by setting up manufacturing facilities. So I think the question is that how do you think these issues will be addressed in the near future? And if there is any more clarity, which is more critical for the sector to adapt to smoothly, is the question I would ask you.
Sure. So thanks, Krishan. So I'll just for the benefit of the audiences, I'll just very briefly talk about what is inverted duty structure situation. So it is a situation where your output GST rate is less than your input GST rate. So that is in nutshell for a layman to understand. This is called inverted duty structure. So while I said, and like Bhanu also mentioned that it has largely been addressed at least for the pharma sector and healthcare sector, that inverted duty structure. However, there are certain components of that which have still not been addressed apart from API's rate, are input services and capital goods. So that was one expectation. What I will really want a government to really rethink on that. That the cost of input services and capital goods, while providing healthcare or pharma to the healthcare and pharma industry, should be linked into the form and under the formula of inverted duty structure that is currently not covered. That really adds up to the cost. If that happens, if the refunds are allowed or the ITCs are allowed in true spirit of GST, then affordability, that's my bet on the table that affordability is going to be far more than today what the government is trying to achieve. So that is one point. The second point, I think Krishan, you also checked on what happens to the state incentives, which are directly linked to the benefit or the cash payout of state GST component. Yes, there will be a situation that the benefits may seem to reduce. However, the intent of the government is to boost the consumption. So it is both ways. Once, one way the GST rate also goes down. Of course, that is linked to the benefit, which was promised basis the calculations. However, government also expects the consumption to go up. So it should not be a very, in long run, it should not be a big miss from the incentive standpoint if the companies have factored, that as a clawback from the government. So that is my take on the incentives. The mathematics needs to be done, and to be done from a long-term horizon perspective, how the demand also increases. So that is a 2 point. And last point, you also touched upon how and what the companies should do. Of course, recalibrate on their MRPs, see their ERP systems, GST masters are updated, GST transition rates are taken properly. So all those factors the companies should immediately, if they have not done it already, they should do it so that the next filing, which is going to happen in October, is complete and it is flawless filing from all legal aspects. So that's it, Krishan. This is
Right.
what I thought I'll share.
No, no, absolutely. Thanks, and very important points here. And this sector is very, very crucial to our economy as well as our as globally, as we are looking ourselves to be one of the large players in this market. We are already one of them. So, it is very important for the industry players. While on one side, their intention is to pass on that benefit. I think the practical implementation will take over a couple of months from here, which will ultimately unfold into a true benefit. But I think with the addressal of some of the inverted duty structures which continues, I think there will be still some challenges in looking at the absolute benefit which might come to the hands of the end consumers and patients in this case. Uh, and the other sector which is equally important for is the FMCG and retail. I think when the announcements were made in terms of making this more affordability being the at the heart of the change, it was meant for masses, and that's why in the FMCG and consumer space there were huge rate cuts which have happened specifically for everyday essential goods, I think white goods as well as consumer durables, where I probably bring in Naveen as the sector expert on this one. Do you see this unlocking fresh consumer demand, especially in the rural market, or will higher input or distribution cost dilute the benefit somewhat? I think that's the question which everybody is kind of contemplating, as what we are discussing and debating also. And with the festive season coming in and this intention of introducing this change right from 22nd of September, how do you see pricing strategies evolving from here and capturing momentum?
No, thanks, Kishan. Good afternoon, everyone. So I think if you look at it from a sector perspective, I think this has been one of the biggest beneficiary from a GST reduction perspective. Nearly 99% of the daily essentials, the government has actually reduced the rate to 5%. Now, if I look at it from a macro conditions perspective also, if you look at typically what we track as a sector perspective is the retail inflation. This has actually got moderated from 3.61% in February to 2.07% in August. So I think the macroeconomics are also fairly supportive of the demand in the sector as a whole. Now, if I look at it from a product side perspective, from an FMCG perspective, I think the whole reduction in prices would happen is all depending upon the supply chain efficiencies, and what we expect the basis discussions with multiple stakeholder is, the effective drop in the prices could be really in the range of 8 to 10% of the existing MRPs. This, if you look at it from a India economics perspective, it's very critical from a rural market perspective because our rural markets are highly price sensitive. And if you look at it from an overall perspective, something that Karan also covered, GST has also been reduced on the farming equipment and other farming details as well. So what will actually happen is this will actually make the farming more affordable, less cumbersome, and also making sure that there is more disposable income in the hands of the farmers. So with the improved income, I think we definitely see a demand that's getting generated on the rural side of the business. If you look at on the urban side, which has been a bit stagnant over a period of time, I think GST reductions would happen, would help in pushing the price, pushing the demand from a product perspective. But one thing that we definitely see that is going to take place in the urban side of the business is, people will tend to buy more premium product. So some of the places where the premium products has a reduction of nearly 8 to 10%, we see a uptick that would happen on the urban side of the business. And I think pricing strategies are at the right time because as the festive season has just kicked in. You would have already be aware that all the e-commerce companies have actually announced the $1 billion sales as well. Just to give you some perspective, I think the industry is expecting to generate a sale of nearly 1.27 lakh crores in this festive seasons on the e-commerce platform. And if I map it to the last year's number, this number is nearly 27% higher than last year's number. So there is a lot of demand that the industry is expecting to get generated on the ground through this e-commerce channels as well. And I think if I look at it from a pricing strategy perspective, I think most of the companies will have a multiple layer pricing strategy that would be adapted for rural and value conscious buyers. Brands are likely to focus more on entry level pricing, smaller pack sizes, regional promotions kind of a stuff. And on the urban premium segment, companies are expected to intensify the festive offers, including some cashback schemes, bundle products, or limited time discounts, or some loyalty driven discounts as well. But if I look at it from an overall perspective, I think this cuts will actually help in creating a lot of volume in the industry, especially where the volumes had got stagnant over a period of last 2-3 quarters. I think we are pretty positive from a sector perspective on the growth that will the GST reductions will help in the overall sector perspective.
Right. And I mean, very, very important point also is that how you look at this timing per se is one that, lot of people were waiting to actually buy. They have stalled their decisions to actually do consumer spending. I think that is what people have started to kind of look at, and companies, the e-commerce companies, the sellers, the distribution network, everybody is promoting GST 2.0 as their, that's their, key part to the sales promotion campaign. But in true sense, I think the benefit is also going to come to the end consumers, is something which definitely is expected. So definitely there'll be a surge of demand. The spending should go up, and that was the whole idea of making such a tight timeline of 22nd September, barely giving couple of not even a month to people to actually adhere to this change. And I think kudos to the industry also have to have having actually managed that. It all needs to be now numbers which will come out in the next 1 month or two when we'll see all this happen. Saurabh, I know that we had discussed about anti-profiteering. I'll bring that back in the interest of time and move maybe to Saket from an auto sector standpoint. We current talked about the GST reduction, Saket, and 28% to 18% on small cars, which is definitely a trigger for demand revival for conventional segments. Also, so to call it probably a risk diluting policy towards EV. Is that something and a play which you see together in terms of having the sluggish sales to the inventory overlag? How do you see this balancing out between immediate consumption gains and the longer term structural push towards the EV segment from a sector expert lens?
Sure. Thanks, Krishan. So, Krishan, I think we'll have to look at it slightly differently in terms of what's the genesis of these kind of announcements. I mean, let me take you back as to how the industry is shaping. Possibly, auto industry is one industry which is undergoing a massive transformation, be it on account of fuel dynamics, or you talk about power terrain, or you talk about the global supply chain constraints which have been impacting the industry. So I think a lot of countries are moving towards protectionism, which is in terms of being self-reliant, which has been the underlying theme of this announcement. Now, particularly talking about the auto sector, if you look at the entry-level cars or the small cars, as we typically call them, till 10 years back, or maybe till 9 years back, the share of smaller cars to the total cars which got sold in India was roughly around 50%. And today, as we speak, this share has gone down from 50% to 23%. Now, do we say that the affordability is not there? The affordability is there, but because of almost 30 to 40% price hike, which happened because of emission norms or the safety regulations, the smaller cars became unaffordable, at least to the masses. And also, if you look at last year, the growth has been, just very, very minimal as far as the smaller cars is concerned. So certainly something had to be done by the government to really address the masses, which is there, as we heard Naveen also talking about, and also in the other panelists talked about. So that's the genesis of really kind of reducing or rationalizing the rates of the smaller cars and not really the mid-segment cars. Mid-segment cars, obviously, any which ways have been having a higher share as we speak. I mean, today, out of all the vehicles or the passenger vehicles which get sold, almost 60 to 65% are the UVs or the SUVs. So that's what the government has done in terms of only focusing on the masses particularly. Second question would be in terms of if you look at from a export reliance standpoint. I mean, auto component export I'm talking about, because Karan did talk about the GST rates on the auto parts. Now, from an export potential, we almost export 33% to North America, the auto components. And because of the tariffs being announced and being talked about, it's a huge risk for the domestic industry. Now, what's the alternative? We somewhere have to kind of infuse those impetus in the domestic environment to have the consumption story built up for the auto component industry in India. So that's a second reason. Third, I would say in terms of the luxury cars, I mean, why there hasn't been much announced on the luxury cars. I mean, there is only a fractional of difference which will happen for the luxury cars, because if you look at most, I mean, few of the luxury cars are imported currently, and with the FTAs being signed now with UK and possibly with European nations also, any which ways the cost or the import duty will come down over the years. So the government has been mindful of the other incentives or the benefits which will accrue to the larger population, and hence the focus has been largely on the masses. And I'll just take a minute, Krishan, to expand to your question in terms of how will it sustain. See, I think the response has been fairly good. Yesterday was a bumper day for most of the dealers. At least we spoke to 2 or 3 dealers in India. I think everyone was celebrating. Why? Because the bookings went up almost very significantly from what it used to be during this period. And this is a most crucial period, the 42-day period. Almost 15% of the vehicles which get sold in India get sold during this 42-day period. So I think the timing is right. It's going to sustain at least in this year. And because of the affordability now being created and the consumption story building up, this will continue in the years to come.
No, very well said, Saket. I think the part which is very important here is that the way the demand was actually being looked at, it has actually started happening already, and that's what I think you also mentioned about how immediate order bookings have happened. People were holding back their this, and the timing was apt, as you mentioned, and Navrata
Even
has
the
just
used
started.
cars, sorry,
Absolutely,
even the used
both
car,
ways. I think both
also
ways from that perspective. And the only pertaining point to this sector was about the compensation cess. I think that's something which had remained unaddressed, because there is a pool of compensations that's on the unsold inventory, which is definitely on a higher segment cars, which is definitely going to impact more because the rates have not come down. But there is no set of a refund of that today, and that becomes a problem. So Karan, do you see this issue getting contested? Do you see any immediate clarity? Because this is something which probably seems to have now past the time at which something could have been addressed. But any thoughts which you can quickly share in the next 1 minute?
Sure. Like, as already mentioned, the finance minister and the government officials have clearly told that this compensation says amounting to close to 2,500 crores for the entire industry. There is no light what they see. And honestly, even the section, under GST, which is section 18(4), does not support it. So what I hear is that, Federation of Automobile Dealers have, gone to petition before the finance minister and the revenue secretary. So the industry pressure only can do something. Otherwise, the governments are very clear that right now there is no refund mechanism or any utilization mechanism, so to say.
Yeah, which is not provided in the law means there is nothing extraordinarily
There is
which is
nothing.
available right now.
Yeah.
Real estate sector has been the boom, and we've seen consumption demand have been something which have, evolved over a period of time, Neeraj. But when bringing you in from a real estate sector standpoint, I think a very, very, very welcome change on cement, which was a very critical input on housing infrastructure, having seen the reduction from 28 to 18%, a very, very, long pending move, which was expected by the real estate industry and the infra industry. How do you see that impacting the project costs and overall availability?
Yeah, sure, Krishan. And let me just try and attempt to clear some mystery around the cement-related announcement, right? I think 28 to 18%, and there's already a lot of calculations being thrown out in the market from 1% to 3% to 5%, right? But let me just divide it into 2, 3 aspects, right? Because it doesn't happen mathematically, that simply the way it's coming out, right? One is that, is it going to impact immediately? And we heard Saket and Naveen talked about the bumper day yesterday for your retail and auto. I don't think that'll happen for real estate immediately, right? There is a challenge of while cement is 15 to 20% in terms of the overall costing, when as far as sector is concerned. But it also depends on at what stage you are in the project life cycle, right? Today, the developer will have an inventory of projects which are already built, projects at a certain stage of construction, projects already starting, right? So all three will have a very different scenario as far as the impact of cost is concerned, right? The other important element is that what is the operating model, right? So today, over the years, you know, there are different models of how the construction is happening across various markets by various developers. There could be entire work done by the contractor. Then there could be a mixed composition where developer is directly buying cement, or there could be things like RCC and all. So all these will create a lot of complexity, right? And while the attempt of the government is in the right direction, right? Because ultimately it wants to stabilize the prices and hopefully reduce the prices, right? At the end of the day, to make the pricing and the sector more attractive, right? And we've seen the challenges around demand with this sector, primarily with the mid-income and affordable housing category. So the way I look at it, the developers are already on the drawing board in terms of, because eventually they also want to pass on the benefit, because at the end of the day it will also impact, or rather make their products more attractive to the end customer, and also spur demand in that direction. But whether it's going to be 1%, 2%, or 5%, I think only the time will tell. But yes, principally speaking, over the years, this should have an impact on rationalizing the prices of real estate, at least the mid-housing, mid-income housing and affordable housing category, right?
No, I agree with you. I think, Neeraj, even from the perspective of affordability and demand, I think the RBI rate cuts, lowering the borrowing costs alongside, are measures which probably will help some part of that. And, eventually it needs to be seen, as you rightly mentioned, what model that you are at, what stage of your construction of the project you are at. Because if you're starting a new project, definitely these are benefits which will come up in substance and form both. But at this stage, if the construction is already completed, I think it will be a very different scenario for people to pass on a benefit which is already for inputs which have already been consumed. It might be so that, some part of that may not be visible immediately, but I think the intent is right. You're right, absolutely rightly mentioned. And intent is to pass that benefit, which puts me back to the question which Saurabh was also trying to address very quickly on anti-profiteering. I think this sector has, earlier had challenges on anti-profiteering because it was very difficult to compute, as you mentioned, the net benefit which is to be passed on. Do you think that is something which will happen this time around? Because you also mentioned that it's not very easy for us to imagine that situation today for different players in the market who are at different stages of, the construction in their projects. So any quick thoughts on anti-profiteering to be addressed?
Yeah, so very quickly, Krishan. So one is obviously the developers need to put up some very simple ways of identifying the cost and the impact of GST deduction, so that whenever if there is any clarification or query from the government, they are able to show those records and computations conveniently, right? While there's no anti-profiteering section or authority currently, which I believe was there in the erstwhile mechanism, I think government is moving with the intent of trust and transparency with the sector. Having said that, I do believe that there would be possible questions coming up. And I think one of the things that developers and maybe a practitioner like us should also do, because today there is a severe gap in the understanding. So today everybody feels that real estate will come down by 5 to 10%, right? Which may not be the case. So I think there has to be some mechanism to create the awareness, also to bridge the gap in the understanding, so that people
Yeah.
exactly know what is really coming out in the market.
Absolutely, absolutely. I think we've spoken a lot on goods and actually on sectors which are the most prominent, but service sector has seen a huge change in terms of the benefit of intermediary, which is now going to be not taxed at 18% for services which will qualify as export. So Raja, as a tech leader, this is something which is a landmark for IT, ITS, export, etc. And this is really offering clarity on cross-border contracts, and which will definitely also keep our global capability centers playing a key role, which is already happening from a talent mobility standpoint. And there is a constraint while on H-1B visa challenges on the other side. How do you see these reforms shaping the future of the tech sector?
Yeah, I think, Krishan, last but not the least, tech sector, right, which contributes 10% of India's GDP, looking at $350 billion of revenue by 2026, employs 5.4 million people. So it's obviously a massive sector. Now, very clearly, GST obviously wants to boost the consumption, as you rightly mentioned at the start. It's 2.5 lakh crore savings, as Prime Minister Modi talked about. So as far as exports are concerned, very clearly the thing that really had to be plugged in was the intermediaries, and they have done that, right? Now, what is intermediary, as Karan very clearly mentioned? It's really basically making services for your overseas parent. And I think this clearly means a lot as far as, I think, one is GCCs are concerned, right? We know the opportunity of global capability centers, right? Already 1,700 moving to 2,500 GCCs going forward. So I think that means a straight 18% savings for Indian companies billing to overseas parent. So that is first. Second is, if you look at software, right? There is humongous amount of software that gets sold in India by global majors, right? All pretty much facilitated by the Indian subsidiaries. Again, very clearly, that's an 18% clean savings for the Indian subsidiaries. So again, a clearly cash flow, working capital, profit, basically pool to the parents. So I think that's what's the opportunity in the sector which has happened. But as you said, candidly, the sector itself is in a tremendous pivot, right? If you look at not just the H-1B issue, you're also talking about the Hire Act, right, which talks about 25% tax on outsourcing. So the sector is actually looking at significant, I would say, uncertainties, headwinds at the moment. But as I've always believed, there are really three things that any businesses needs to have, and I'm pretty confident the tech sector would come out from. I think the first is talent. The sector is about talent, which means the STEM talent continues to be the highest in India across the world, which means we need to upskill the talent. Second is value. We're all living for customers. If we use the agentic AI and what is coming more for our customers and build efficiency and value creation, clearly, wherever the customers will come to India. And third is innovation, the Indian startup ecosystem, which is third largest globally. So I would say value, talent, innovation, along with, as you highlighted in terms of the current GST push, would clearly determine our opportunity to take this moment. We are in a tough spot. Let's not kind of kid that. But I'm quite confident the tech sector will come out of this.
No, thanks, Raja, and I completely agree. I think mobility of people is one issue, but which needs to be addressed, because that is something which will definitely have certain challenges to kind of bear with. But the sector has completely, I think this was something which was a long pending ask. So this will definitely attract more investment in terms of setting up more centers. I think it will be also boost to employment automatically with the talent which is available in India, and India becoming a global GCC hub, and especially taking it down to tier 2 and tier 3 cities is something which is definitely, people were waiting for this move. I think it will definitely add to that benefit of real cost plus scenarios to be actually built out back to the captive units to their parent companies. It's something which will be a true benefit to them now.
Yeah,
And
I think the only thing I will add, Christian, is that moving from cost to value, because it's not just talent, but talent plus, which is talent with AI. That's what's going to really provide value for all.
Talent plus minus GST, I think is the key. I completely agree. I think we are at the end, and sorry if we overshot a bit, but my last points kind of to sum up to Saurabh, if you and Karan could kind of quickly answer top 2 or top 3 things as key action points for the companies, if you see them to be complying, as well as to look at ensure that they are passing on the right benefits, but minimal disruption, what would they be? In words and points.
Yeah. So yeah, Krishan, I think most of it is already covered. So I think largely, people have spoken about what it needs to be done. But I think from a business standpoint, I think key action points, if we could bucket it, probably compliance and reporting, that would be important, updation of ERPs, accounting systems to align with the revised tax rate, evaluate the ITC eligibility under revised rules. I think that is from compliance and reporting standpoint. From pricing and contracts, I think it's very, very important to revisit the same tenders, pricing agreements, all of that needs to be seen, effective pass-through and of benefits rate to reduced rates to customers to avoid anti-profiteering, though not operative, but department may ask data at any point of time. I think the third point is operational readiness. I think very, very important that you train your people, coordinate with your supply chain partners for smooth implementation of the changes, which will impact the ultimate invoicing, etc. Review the stock in transit at the warehouse and apply the correct rates. HSN analysis is very, very important from a classification. And I think lastly, from my side, risk and audit preparedness. I think it's very critical to do an internal GST health check to identify gaps in terms of reportings and ITC claims. Documents need to actually highlight how you've done the pass-through methodology, because at the time of assessments or, audits by officers, etc., they may want to understand how these have got into play. So from an overall perspective, immediate priorities are systems, ITC reviews, training, pricing adjustments, communication with channel partners, and of course, HSN classification.
Sure. And Karan, lastly, anything which is, if you had to look at the reforms and say one thing which is missed out right now, could be aspirationally there, what would that be?
So I would, really suggest government to bring in petroleum into the GST net, because that is
So inclusion of
key to
petroleum products, yes.
inclusion of diesel, petrol, especially because that is key to all the sectors, and that is the very, very genesis of the cost of
And
all the
then
sectors.
completely agree. Large part of ATF, aviation turbine fuel, and natural gas, which is a key component for manufacturing
Yes.
sector, is a very important ingredient. And there was it's been long pending. The whole modality is being worked out, but we are still waiting for that clarity. Government saying that we are not going to make money changes in the near future, and reforms have already happened. Kind of tends to for us to kind of put food for thought whether that will be part of that reform or not, or it's going to be 3.0 is what we expect the
It's
next
going to
reform
be
segment to come in.
constitutional amendment
Yeah,
for
that
that.
requires a constitutional amendment as well. So, but
Yeah.
thank you. This was really, really insightful and, I think very, very interactive. Thank you to all of you, gentlemen. And I hope that our audiences, which have continued to be with us, even if we have kind of exceeded time, thank you so much for being there. Please put out your questions. If you're not able to answer, apologies. I try to cover most of them, but we will happy to address any questions. You can reach out to us on our on our website. We will be happy to engage with you. If you want to put out any questions and leave them in the chat, we will still look at it and try to see if we can answer them back to you, even on the audiences which joined on social media platforms. Thank you, everyone. Be from our side, and we're signing off here. Look forward to many more such interactive webinars in future. Have a good evening. Thank you.